What is going on YouTube? It's Dividend Investment Guide here with another episode. Doing a brief update on my new portfolio and how it's been going, seeing as the market has been rising for the past few days. Well, since yesterday, which was Monday. So at the moment, we are currently clawing back all of our losses. As you can see, we're just on Simply Wall Street at the moment. This isn't 100% accurate because I haven't put the right dates in for buy-in, but it does give you a brief line of exactly how I'm sort of going about my portfolio and what I'm looking to do in the future. So as it stands at the moment, in terms of value, we've got really good value on everything we've been going for, simply because of the crash. It's been quite a convenient time to buy, to be honest, so hopefully we're going to see some solid returns on that. We have got the American markets opening in about 4 minutes, so I'm going to try and touch on this and then we'll get an updated. So current, I am at £92 down, which, considering it was about 230 not too long ago, I'd consider that quite a good position to be in right now. So as I say, this isn't 100% accurate, so returns since inception says minus £17.20. This hasn't been updated today, so this will be of last night. Total return minus £20 because of the currency as well. So as you've just seen, that doesn't fully reflect what I've got going on. I've got the right shares in there, I just haven't put the dates on there, so obviously there's some currency conversion and a few other bits and bobs that aren't fully correct, but I'm going to update them hopefully today and take it from there. Really, it should be a bit more. So in terms of returns, our beta, which is the volatility, we've got AGNC, which I'm surprised is one of the most stable ones, and obviously Carnival Cruise Lines right at the bottom there because it's up and down like a hooker's knickers. So we've got CCL, Taylor Wimpey's around here, we've got Aviva, so we've got quite a lot on the top end of the volatile side of things. We've got about 3 sat there on the less volatile side. Moving on, we can go to contributions, contributors to returns. So there's only really Taylor Wimpey there that's weighing us down. I don't really know what that one is, if that's anything. Just above Taylor Wimpey. It looks like it's a separate bracket, but yeah, not quite sure what that one is, so it's not fully reflecting things there. I can probably download it and see it better, but for the purpose of this video, I don't really see the point. So going into diversification, obviously we've got, it's a bit easier to see on this one, I believe. So if I go into mortgage REITs, obviously AGNC, got telecoms with AT&T, we've got multi-line insurance and life and health insurance with both Legal and General and Aviva, which are both on the FTSE 100. Then we go into oil. For some reason, Energy Transfer are showing up on here, which is quite surprising. But obviously we've got ExxonMobil, BP, and that makes up 18% of our portfolio. 17% is Exxon alone. Then we've got Taylor Wimpey at 25% of our current portfolio based on value, and CCL, Carnival Cruise Lines, which doesn't actually give me a percentage, but it also doesn't on telecoms as well. Moving on, our valuation. So based on our current price, it believes that my current price is £971.35, but my fair value is £3,098. So with this app and with this website, I find that it doesn't fully reflect it properly. I would expect fair value to be about the £2,000 to £2,500 mark. I think 3,000 is a bit of a push, but it purely depends on, obviously, analysts and what they believe the companies will be valued at within the next year or 2 years. I think a lot of analysts go off. So price to earnings, our portfolio is quite a low PE compared to the market. So it's quite diverse in that sense. We've got 7.9%, 7.9 times, and the market average is 12.6. So we've got quite a good PE ratio there, but obviously the market has been going up, so that will affect the PE as well. So price based on expected growth, or PEG rating. So our portfolio is 0.6 times and the market is 1 times. So again, really good value companies I believe I've bought here, and I'm looking to hold these positions for the next 2-3 years, potentially get out of Carnival Cruise Lines if I get the opportunity. But I don't know, it purely depends on whether I want to invest in something else, which is, I believe, is going to grow a lot quicker than Carnival, because I can't see them making money for the next 2 years, to be honest. So price based on valued assets. So again, we're below the market average. So I believe I've got quite good valuation here. Expected annual returns growth, earnings growth, sorry, 17.6 for the next 1 to 3 years. So future average 17.6%, and future average 9.9%. Which, considering the market average, we've gone for highly dividend growth companies at the moment. I believe that's the best way for me to do it. Starting out from the bottom, obviously dollar cost averaging myself up, and eventually getting to the point where the companies are growing, they are paying a steady dividend and growing that dividend as well. My biggest concern with all of this is my portfolio debt level. So the companies I've bought in have high levels of debt. I don't know how up to date this is. I don't know if it's recent, because if it's recent, then a lot of companies will have to go into debt simply because, well, it's going to be hard. A lot of companies aren't making money at the moment. And as for dividends, our total dividends equate to nearly 15%, which is really solid returns on what I've bought in at. Obviously, they are a bit more volatile, the company I've gone in at, but hopefully they will stabilise as the market comes to more of a standstill and starts steadily growing, as it has done every time there's been a problem like this, or the financial crisis of 2008, or the dot-com of 2002, and so on. So yeah, so that's an update on my Simply Wall Street dividend portfolio. So the market's open now for the USA, so let's have a quick look where we're at. Watch it not work now. Okay, so American market's open, so we're £90 minus before, we're up to £42. I'm hoping that's going to go up for the next 30-40 minutes though, people buying in as soon as the market's opened. But as you can see, AGNC, as I mentioned to you previously, I take it a lot of people are trading 212 app does seem to be a bit of a pain sometimes. So I did buy in just under $9 most recently, which has put massive gains onto my portfolio. AT&T goes ex-dividend tomorrow, so I imagine quite a lot of people will be buying in just for that. As for Aviva, they go ex-dividend end of the month. BP, I couldn't even tell you. Carnival obviously cancelled dividend. Energy Transfers about 22% dividend at the moment. Legal and General, which is one of my biggest earners at the moment, returning 25% on my price basis. And Taylor Wimpey's, obviously, it was minus 70 last week. Now it's slowly growing back up towards the, hopefully hit zero, and then go into profit next week, providing this virus stabilizes, like it looks like it has been doing. But anyways, guys, thanks for watching. Don't forget to hit the sub key, don't forget to hit the thumbs up, and I look forward to catching up with you in the next episode. Cheers, bye now.